Broker Bulletin acknowledges the traditional custodians of all the lands across the country on which we record our podcast and pays its respect to all Aboriginal and Torres Strait Islander people. Welcome to the Broker Bulletin podcast, where better begins. Join us as we chat with brokers about what's working for them, what drives them, and the real challenges and wins that matter most right now.
Hello, everyone. Welcome back to a brand new episode of Broker Bulletin. I'm Grace Ormsby, coming to you live from Growth Summit, and we've just heard an amazing chat all about the economy. And we're going to take that a little bit further in this conversation than you would have seen if you were here in person. But we're looking at how the economy will make or break brokers. And it is an absolute pleasure to be joined by Mousina, Deputy Chief Economist at AMP. Diana, welcome to the show.
Thank you, Grace. It's lovely to be here.
You've just got off stage. You just talked to our brokers for an hour about what's going on. For those that don't necessarily know you, can you give us a little bit of insight into yourself?
Sure. So I'm the Deputy Chief Economist at AMP. We look at what's happening with global markets, with Australian markets, and we make predictions on what's going to happen in the future in terms of share markets, growth, and we come up with forecasts for GDP and inflation, interest rates, and basically how that all can impact your portfolios, because AMP is ultimately a superannuation fund. So our main goal always at the end is how does it impact your superannuation returns?
I feel like it's a pretty dynamic space.
It's all encompassing.
Yeah. If you did have to give the economy of today, the 2nd of April, to timestamp for everyone who is listening, 2025, what grade?
For Australia?
For Australia.
I think I'd give Australia like a 6 out of 10 at the moment. We've been through a pretty challenging time in the last year and a half. We've had pretty low levels of economic growth for Australia. Our GDP levels, GDP, for those who don't know, is gross domestic product, is basically the best guide to activity in the economy that economists use. And we've had GDP growth of 1 to 1.5% in the last 1.5 years in Australia, and which is pretty low. We should have levels closer to 2.75 or even 3%. These are the lowest levels of growth that we have had outside of the pandemic since the early 90s recession. And that was sort of partly expected because the Reserve Bank raised rates quite a lot. We went from an interest rate of 0.1% around the pandemic to 4.35%. So it was a very fast hiking cycle, the fastest hiking cycle that we've had since the late 1980s. And the purpose of taking interest rates higher was to slow growth, to reduce inflation. So I guess I'm not surprised that we had such poor levels of growth. We also had very high inflation, which was challenging for consumers and obviously led to the cost of living environment and challenges that some consumers are still finding themselves in. But I think the outlook from here is better. The consumer is stronger compared to where it was a year ago. We've had lower inflation. We've had tax cuts. We've had the start of interest rate cuts now, and I think we're going to get more. The global economy looks more uncertain, though, because the US was performing very strongly last year, but there's a lot more uncertainty that's clouding the outlook for the US economy. But I think we should be focusing more on our own domestic issues, and domestically, things look better here.
What I'm going to ask you next is how then would you say the global economy is performing, if you had to give that a scorecard?
You know, for the global economy itself, actually growth is still holding up relatively well. So I'd actually give the global economy like a 7 out of 10 because global growth is still running at about 3%. The problem, though, is it's the outlook, which is looking more uncertain. So the outlook probably gets like under 3 or 4 out of 10. But as things stand right now, things are actually okay. And the US has had very strong growth in the last 12 months. It's just that the US policy decisions around tariffs, around the reduction of the federal government workforce, around the cutbacks to population growth through immigration, that places some clouds around the US economic outlook. And I guess because the US has been such a source of strength for the global economy in the last years, it makes people understandably worried. And the US share market is the largest share market in the world. It has a very large weight in global share markets. So all other major markets tend to price off what happens in the US. So if you see a big downturn in US markets, that will lead investors to concern that other markets are headed for a slowdown too.
Leads really, really well into my next question, Diana, which is just around what that might look like for Australia. How vulnerable are we to feeling the impacts of what might be happening overseas at the moment?
We're vulnerable in some aspects and less vulnerable in other aspects. So what's interesting about Australia is that since we've had an increased reliance on China in the last 20 or 30 years, we've reduced our dependence on the US massively. China is our largest exporting partner and our largest importing partner too, actually. So our largest trade partner overall. So we are reliant on what happens to Chinese growth because they are the ones that demand our major exports. So from that point of view, from an economic point of view, if the US economy falters, it doesn't mean we go into recession. It doesn't necessarily mean that we have softer growth, but it does impact our financial markets because our share market does trade closely to the US. The US market is a very strong barometer for the rest of the world. And if US shares fall, we tend to get a fall. Even though we have different companies that are listed on our stock exchange, we have very high weighting to banks and to commodities. The US market has very high weighting to the tech sector, for example. So we have different markets, but it's the contagion effect that goes in financial markets, it's the contagion impact in financial markets that is really what drives this indirect impact of what's happening in the US to Australia.
That's really, really interesting to see. And I guess good to know, reassuring.
I think a lot of people think, if the US sneezes, Australia catches a cold. It's not really true anymore. In some aspects, I think from the financial market point of view, but not from a growth point of view. We don't experience the same cycles as the US anymore necessarily.
Everyone who is listening to this is probably wanting me to ask about interest rates, Diana. It's obviously been something that we've been talking around. It's always in the consumer lexicon. It's obviously been exacerbated by the fact that we did see so many falls, as you said just before. It's been a pretty compressed period of time where we've seen a lot of action. And we've just seen the first rate cut in what could be more of a cycle around that. Where do you see that playing out for the rest of the year?
So we think that we're going to see another rate cut from the Reserve Bank in May and then another one in August. So 0.25 in May, 0.25 in August, which would mean a cash rate would end the year at about 3.6%. That's obviously still pretty elevated. It means that discounted mortgage rate may get to the low fives, but still pretty elevated at 5%. The lower inflation environment allows the Reserve Bank to be a bit more comfortable around cutting rates, but it's hard to see significant rate cuts because I think the Reserve Bank is still concerned that they might lead to a spark in inflation again, which they would want to avoid by cutting rates too much.
What then does that mean for brokers and their clients? Like we talked about the actual rates themselves, but are you seeing people flock? Is there an effect on the confidence levels, or will we see changes to borrowing behaviour as a result of this?
I think rate cuts always lead to a change in borrowing behaviour, as do rate hikes. So changes in interest rates obviously impact the most interest rate sensitive part of the market, which is housing. So lower rates will encourage people into the market because they can borrow a little bit more. I mean, we're not talking that much more because the 0.25% rate cut in February, for example, only increased your borrowing capacity by about $11,000 for an average income. It's not that much. A few rate cuts will obviously increase that a bit more, but it's not significant enough, I think, for someone who, for example, didn't have enough to get into the market for suddenly to be able to have enough. I think it's just an additional help. And also, it's the confidence that rates probably are headed the right way rather than the wrong way. So obviously a big problem for consumers has been that mortgage rates have increased to such a high level that it's really been a drain on their income and consumer purchasing power. But now that that's reversing, people feel this confidence like, well, I can afford my mortgage a bit more now. Isn't it? It's always the additional little bits that help households. So the rate cut in February has encouraged more people into the market. We saw that with auction clearance rates. We saw that with home price growth. It started to tick back up again. And I think that further rate cuts will encourage that a bit more too.
That cash rate has obviously been really the biggest headline of the last 12 months beyond that. But are there any other big economic trends that you're seeing at the moment that brokers, if they're not already aware of, really should be on top of at the moment?
The major things that are going on at the moment is interest rates, as you said, the slowing in inflation, a pickup in economic growth in Australia, and tariffs in the US and policy changes, which will slow US economic growth, basically. So it's the political challenges globally, maybe political challenges domestically, that doesn't impact our market so much. Better growth conditions in Australia, although a softer labour market. So the unemployment rate's likely to increase a little bit further. It means that there's not as much flexibility in the jobs market. People are looking to get in and out of work. It'll be a bit harder. There's not as many job advertisements out there. So the labour market's not as tight. It's hard to get as much of an increase to your wages if you're moving as well, because wages growth has slowed. So the constraints to the labour market mean that people will be moving around less in the jobs market, in Australia in particular.
It's interesting, I think, especially to note for brokers, this is directly going to be impacting their clients? And I know if you don't, you're looking at macro trends and all of that, but is there anything that you think brokers should be more concerned about, or, think of any opportunities or threats that are on the horizon that they just really need to be informed about?
The biggest threat is that wealth could decline as share markets fall. So if we get another, say, 5 to 10% drop in share markets, that will reduce people's wealth because people are invested in shares. That will obviously reduce how much they have. For retirees, it's important because they're living off those investments in shares in particular. So I think household wealth has some challenges in the short term, and usually share market declines get people a bit concerned. So that's, I guess, something that may not be front of mind for brokers, because usually by the time that share markets fall, it's sort of too late to have that anticipation of them declining. So share market falls normally tend to be quite worrying for consumers, I'd say.
Do you think there's any expectation, both domestically and abroad, I guess, that regulation and policy changes will come into play in the next 12 to 18 months, just following on from some of those economic shifts that we have been seeing?
The biggest regulation changes related to housing in particular may be APRA's serviceability buffer, but if anything, that would probably reduce, which would be better for borrowing capacity. But other regulation, I'm probably just not close enough to know anything else in terms of not any specific tightenings in regulation that I'm aware of.
Well, that's reassuring in itself.
I think if anything, it'll be that APRA serviceability test that a lot of people have spoken about needs to be reduced. Yeah.
And then I guess looking sort of further ahead, if we push out to 2027, 2028, 2030, obviously we are using a crystal ball here and we don't know how, anything could happen tomorrow. But what is your expectation of the next 5 years or so? I
think we're going to have inflation that's a little bit higher than where we'd sort of used to, or where we'd like it to be, running at about 2.5% to 3% band rather than 2% and below. And the reasons for that is because we have an aging population in Australia. We have a lower rate of youth to old people. So that's a drain on savings. That tends to be inflationary, which basically means interest rates are not going to be cut back to 0 or even less than 1%. Interest rates are going to stay, let's just say, somewhere between 2.5% to 3.5%. I mean, there are going to be cycles in between, but interest rates are likely to stay a bit more elevated. We also have higher inflation from higher defence spending, higher budget deficits, less globalisation. One potential offset for inflation could be AI and the productivity improvements for AI, but we're not there yet. We need another 5 to 10 years, I think, to really see any improvements in productivity or inflation from AI. So a bit of a higher inflationary environment, that's definitely a mega trend. The other mega trend is more inequality around the world and in Australia. And we can already see that in housing, but I think that the inequality problem is getting worse because people with assets are continuing to get wealthier, but a lot of people are now more asset poor than before because it's harder to get into the housing market. So that's a challenge, especially from the old to the young divide. I think that generational divide in angst against wealth is going to continue.
One thing that you did mention towards the end of your talk in front of all the brokers today was just around how the infrastructure spend has that funny effect on housing, where you see that kind of move away from people to those infrastructure spends, and that's when we see housing lag behind. Is that going to be a critical issue continuing forward?
So the problem has been that we've had very high levels of infrastructure spending, and I fear that has crowded out basically spending on housing investment. I think it's going to be less of a challenge in the future because the infrastructure budgets have actually been cut back quite a lot. So the government's planning to spend less on infrastructure. So if anything, I think that's going to be less of a problem actually in the next 10 years than it has been in the prior 10 years.
So that housing target of 1.2 million houses
in 5 years, yeah.
Where are we at with that?
We're very unlikely to achieve it. We are currently building about 180,000 homes a year, which would building 240,000. It's going to be really hard to achieve that target. I just don't see how we have the resources to be able to do that. I think it's fair enough to set a target and to want to build that level of dwellings. I just think in the current environment, it's not going to be possible, which is sad because we need to be building more homes to reduce our supply and demand imbalance of housing. We don't have enough homes relative to demand. We have an undersupply of housing. So we really need to get the supply up.
So coming back full circle to what we were talking about at the beginning, Diana, around that report card, where would you like the Australian economy to be sitting? Like, what is a good scorecard?
Well, I'm an overachiever, so I'd say 10 out of 10.
Yeah.
But that's never going to be possible. There's always going to be challenges in any economy. But I think Australia, there's reasons to be optimistic on the economy. We have a very highly skilled population. We have an aging population, but we are bringing so many skilled young migrants in that we do have, a dynamic workforce that is flexible. I think the pandemic showed us that the Australian workforce is very flexible. There's reasons to be optimistic on that. And also we have a lot of natural resources that we're gifted with that mean that we can expand our export capabilities in things like critical minerals to the world. But I think we need to be better at building on our science skills. We need to have larger levels of business investment. I think our education standards are lacking. And I think we need to get high levels of female participation in the workforce too. It's already at a record high, but I think that we can do more on that, which is around childcare provisions and trying to increase the level of part-time work that women have in Australia, which is a bit high compared to some of our global peers. There's always going to be challenges, though, and no country's doing it perfectly. And there's definitely reasons to be optimistic. I think Australia will perform well, and hopefully we won't have a recession for the next few years. We were very fortunate that outside of the pandemic, we hadn't had a downturn in nearly 30 years. So I'm not sure if we can replicate that again, but I think there's definitely reasons to be optimistic about the growth outlook.
Some really fascinating insights and some great food for thought for all our brokers at the moment. Thank you so much for sharing that. Before I do let you go, I do want to ask you, because at Broker Bulletin, we're all about finding the 1% improvements and seeing what people are doing each and every day to enhance their own performance. And whether that's in your career or in life, is there something that you do without fail every day that you think helps you be who you are? Putting you on the spot here, sorry.
I really like having my cup of green lemongrass and ginger tea at night. That helps me to center myself and just to let all the stress of the day go. I have 2 young kids, so I do feel like life is very chaotic trying to fit in. I have a demanding job which requires a lot of analysis, a lot of communication with people, a lot of travel. And I do find that does drain me a lot, plus, the caring responsibilities at our home. So I find my life is incredibly busy and it's very hard to find time for myself. So that cup of tea at night sort of is that at the end of the day. I don't watch much TV, but I do have that cup of tea.
I feel calmer already.
Actually, what I have been doing lately is crocheting. I've been crocheting some bags that I found. You can get the patterns on Instagram and Etsy, and I find that is another way to calm me with my cup of tea.
There you go. Multi-talented, multitasking. Diana, thank you again so much. I think my biggest takeaway from this is really that the Australian economy is still strong. Yeah, there's always obviously room for improvement, but I think for the brokers out there, to take advantage of living really in such a great place when it comes to that economy. So thank you again.
Thanks so much. Thank you.
To everyone who is listening, if you have a topic you want us to discuss, please email us at brokerbulletin@lmg.broker, or you can direct message us on Instagram at lmg.broker as well. We'll get back to you as soon as we can. If you like this episode, make sure you rate and follow us in your favorite pod store. See you next time.
Thanks for tuning in to Broker Bulletin. We would hate for you to miss an episode. Subscribe to Broker Bulletin in your favourite podcast app. Has this episode been helpful? We'd love you to rate and review us. It'll help us deliver content that's useful to you and help others discover us. If you have great ideas for topics worth tackling or have burning questions you'd like addressed on an upcoming episode, reach out. Links in the show notes. See you next time.